All right, glad to be back with everybody after a few days off, trekking down to the southern part of our state to one of our many national parks that we have here. And if you haven't been to Utah and you haven't been able to come out and see what we have to offer, I highly, highly recommend it. But glad to be back, and also glad to see the market really didn't do very much while I was gone, which is pretty rare for a David Settle vacation. But we're going to break down where we're at right now, where we're standing, and what good sign that we saw from the markets today that could signal the potential for more risk appetite going forward from here, at least for the next couple of near-term months. I'm going to break that down, what some of these other markets are showing us. And then we're going to take a look at a stock here that has been pretty strong. We're going to talk about how to trade a stock on the strong trend that actually has both a pretty strong resistance and support level despite the trend. So let's go ahead and get started. Today is Monday, June the 22nd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we're back to a dark green shading in the green line here, which is bullish, strongly bullish. You also see, too, that the S&P is still between the 0 and 23% retracement of the rally, so we really haven't retraced yet. The blue line is the retracement levels of this move higher. So we haven't retraced, we haven't broken, we haven't really broken above the 0 yet either. So we're still we can go up and down. As I mentioned to you before, even when we're over here, we can go up and down between 0 and 23 very, very quickly. But the next time we go below to 23, if we go to 23, well, the next time we will, because you always will, right? You never not retrace. It will be below the moving average at that point. So we'll get not just light pink shading, but a yellow line as well, like something like this. So we'll see how that plays out if and when it does occur. You also notice too that these Fibonacci retracement lines of the drop, right? So this would be the retracement of the drop, having broken through the 78% retracement level, which signifies a new trend. We had come back down below it and are using it for some resistance, and that's again, if you recall, the NASDAQ is well above its 78% and all the way up to 100%, and is actually flirting with its old highs. And the Russell 2000 has not broken its 0% or 78%. That's where it peaked, but it has, after having dropped below the 62. And its own 23% retracement of the rally, it's gotten back up above both lines and has kind of held them for support now during this little sideways action and bouncing back up. You notice the near-term line, after the momentum line getting extremely low, and forming a bearish near-term high point. As of right now, all of these are potentially forming a bullish near-term low. So we might be able to nullify that bearish near-term high point if we can bounce off of this, break through these lines to new highs, and get going again. We'll see how that plays out on some of these other charts, but that's what these the market forecast charts in the daily. Now, I wasn't with you last week because of vacation, but let's take a quick look at the candle or at the market forecast for last week's. You can see the posture is dark green shading, right? We have dark green shading. We don't have a green line yet. We have a yellow line because of this big drop. But at least we're up above, what is a slightly falling moving average, back up above it after opening below it last week. So that's a good sign. You can also see, too, after getting below, the intermediate line is now crossed up above its market sentiment on this long-term basis. With the near-term line potentially bouncing up here, similar to something like this move, or even this move. This was obviously at the, we were so far extended away, but over here where you had, the pullback, the light pink shading and the yellow line, after bouncing away, we came back down the near-term line and then turned back higher again. So you can see we've got the potential for, some bullishness here, at least in the near term, to persist for a while. So a good sign going into today. A good sign for the posture. You can see the intermediate line didn't drop, but if it did drop below the market sentiment, it's back up above it, and we'll see if it can get back into something similar to this here, get back stay above the market sentiment line, get back into the upper reversal zone, and get going here for at least a week or two. It's kind of what I was expecting on this first pullback. I kind of actually expect this pink shading to be the second one. I think this one was our first one. It doesn't look like it because we didn't actually get the intermediate line bound below 80, but we got really close and we did pull back to the moving average, very similar. So I think this is actually our second level. So we might get another week or two of a near-term run or two out of this before potentially getting back up to these old highs and maybe even up a little bit through it, with the Russell 2000 getting up towards its highs too, before we kind of run out of gas on this intermediate run. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. Also, there's a subscribe button down below the video if you're watching us on YouTube. While you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, that you want us to do another video again tomorrow. It's a quick way to give us feedback. It's our only survey we have. So if you want to let us know that you like our videos, you can do it with one click right now while you're watching. Also down there, comment. What questions or comments you have about anything I talked about in the video today, let me know down below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow us on Twitter for more content in between videos. My handle there is @DavidSettle42. And join our Market Outlook Facebook group that we've created. Also, if you're watching us here on our website, you can see our Market Outlook live video here. Click there to watch those videos. When I do the Market Outlook, I also do a live video at 3:30 Eastern Time to review all the old trade ideas. So that's where you can get that. There's also our upcoming classes. I got my directional option strategies class tomorrow. A lot of the trades we do in these Market Outlooks are some samples of what I do in that class, in that trading room. So you can attend our classes. Again, all of our monthly subscribers, here our plus subscribers, they get access to all of our trading rooms and our Market Outlook live videos. Of course, our premium subscribers get access to all of that, plus our online coaching sessions, our Q&A sessions, our group Q&A sessions, as well as all of our premium tools that we have available for you and resources that we have available for you as well, in addition to access to the community, to all of our class forums that we have. All right. Also, too, engage with us down here on social media. Hit this heart. It opens up this window. Click on the like button. Click that thumbs up. It opens up a new tab. And like today's Market Outlook Facebook post. Again, that benefits us because the more likes these posts have, the more Twitter and Facebook will send it out to all of our followers on those platforms. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's take a look at the long-term chart in this Hakinyashi, and you can see after getting a transition candle last week, we're starting off with a pretty decent bullish candle. Now, it is a higher close. It is not a higher high point, so we'll watch for that for the end of the week. And we're not closing anywhere near above that high point. But we also don't have a lower close yet either. So for the rest of this week, we're going to kind of watch to see if we break back down, then we end up with a kind of a second transition candle, and we'll see what happens with that. Otherwise, if we close up near those highs and potentially get a higher high by the end of the week, then we know, okay, we're back in business in terms of a bullish Hakinyashi trend again, especially considering that we have this golden cross now that we have on the S&P. We don't quite have that yet on the Russell, and obviously we've had that for a long time now on the NASDAQ. In fact, the NASDAQ has got a very strong bullish Hakinyashi candle here, with close to a higher high, much higher close, and not anywhere close to a low point. And you can see it's a really small body and candle on the Russell 2000. So after a pretty significant transition candle, the Dow looks very similar to the Russell, just not quite. It's just above the 200-day moving average instead of a little bit below it. So the S&P is very heavily influenced by the positive trend that we have right now in the NASDAQ composite. If you look at the 3 green arrow chart, we don't have 3 green arrows quite yet. We have 2. The MACD histogram is getting closer. If you take a look at the two-line versions, that's why the MACD, at least it's not dropping anymore. It's like it's barely dropping here to slightly lower lows, even though so far right now this is a much higher low point. The stochastics has already crossed above its moving average, and MACD histogram's turning up. We're actually we've held the 17-day and flirting with closing above. In fact, we did close above by a couple tenths of a point above the 8-day moving average. So very, very good sign. Even IWM did it too. As weak as it's been, it closed above its 8-day moving average. Of course, the NASDAQ 100 is well above its 8-day moving average, and it has been this pretty much since April the 21st. It's been above. Excuse me. There's one day right there. Looks like on May the 13th, where it dipped for a day, as well as, for that matter, on May 1st. But you can see every day it's dipped below the 8. It's come right back up above it, and there's another day on June 11th. So it's a nice, good little trend. Nicely good little trend that's showing up here on the 8-day moving average. Let's take a quick look at some of these other oscillators on the S&P. You can see, we had come back below 60. We're not quite back up above it yet. But on the other hand, we didn't fall below negative 100. So, we're really not changing the trend. Fortunately, where we cross below 100, we might get this intermediate pullback. We did dip a little bit there, but it didn't break the new lows, didn't break the 23% retracement, so similar to this move. So no real significant patterns yet that would suggest that we're breaking through anytime soon. The ADX, after really moving up here with a strong pattern, bullish pattern, has come right back down with sideways action. The negative index has gotten above 25 and still there. The positive index has dropped below 25, but at least hasn't fallen below 20, because that's when you start to worry about a change in trend. And for example, over here or over here, and we don't have that yet either. So, so again, we have pullback patterns on these, but not change in trend patterns. You can see, we fell below the 75% line on the bandwidth, but we're still in the upper half of the bandwidth. And we're still above the point of control, as well as in the close to the top end of the value area here. When you look at the intraday chart, you can see how sideways we are. I mean, we're pretty sideways right around the chart's midpoint. Like I said, we filled in the rest of that gap there. We've been kind of moving sideways. You can see a big volume gap here above this 311, getting above 312-ish. We actually had been trading up above 312 earlier in this afternoon session before falling back down. Looks like the 309 here. So we'll kind of keep our eyes on that. But if we can break through this little value area here, 313, then you can see how easy it will be to move the 320. Just really, really easy. Whereas on the downside, there's a lot of volume down towards the 4-week point of control and the bottom of the value area. So, now it breaks through that level, and that's a different story. That's a 23% retracement level, and now that's something different. But again, it's got a lot of support below us and a little bit of resistance above us before it has the opportunity to take off again. Let's take a look at today's volume and trading range. The trading range there below average, or just over 4 points. The volume at 74 million. Remember, those seem small. I mean, they are small numbers, but you remember, small numbers, when these two lines go down, that's bullish. It's not bearish, right? See, when they go down, it's bullish, and we need to get this down. Again, the 1% mark is 3.1 points. So, as the ATR gets smaller and smaller towards that 3-point range, that's when we know we're pretty, we're kind of set in this trend. You can see from the Ichimoku cloud, as bullish as weak as we've been, relatively speaking, over the last little bit, the trend strength indicators here are still both very, very strong. And then going into last week's candle, you can see, we're still not quite to the bullish level yet because of how strong that bearish candle was, but we're back up above the weekly Ichimoku cloud, so those are a couple of good signs. We're still not above where we were 26 weeks ago, so the red line is actually below the price, which it still kind of says we're not quite there yet. So we might seem kind of strongly overbought, but this tells us we're not really that quite overbought. We're still hugging the Ichimoku cloud. We're not pulling away from it like we did here or like we did here, and we're not trading. The red line's not trading up above the price, which means that we're heading up to new highs and such, and we don't have the strong. So we're not quite strongly bullish yet on these long-term charts. Let's take a look at the VIX. VIX jumped up today, but then fell throughout the rest of the day and ended up back in the neutral range. So we're kind of flirting with getting up above here into bearish territory. But again, getting up above 1 or to 1.05, 105%, would suggest, the possibility that we could get an intermediate pullback, and we were flirting with one right there. We got to the 23% retracement level on the S&P on that bounce in volatility. So not quite there yet. And if I take a look at the ATR for the VIX, you can see the 3-day ATR, after bouncing up a little bit here on a relative basis, has come back down below the 2% mark. And again, when you get to these really low levels on the VIX this is the S&P up here. Let me take a look at the VIX. There we go. You can see we're still relatively elevated. So we got this pop because the VIX really got compressed. Its lowest level since back at the end of the year last year. The VIX got down to really low levels. So it's still at a relatively higher level, which means it has an opportunity to compress more without running into the danger of a pop again like we saw here. So an opportunity to be bullish for another week or two, according to that chart. All right, so to summarize our technical outlook, we've been strongly bullish on a trend basis. We had a little bit of a drop, not a pullback, because we didn't break that 23% level. And we bounced up, but we're kind of hitting our head against some old resistance from a Fibonacci basis. But by getting back above the short-term moving average, showing some positive signs from a volume and trading range standpoint, looks like we are back into the slow grind bullish march higher here, led, as we saw today, by those NASDAQ, those large cap tech names. We'll see how long that takes us, whether it takes us a week or two or a few more weeks. But my expectation is we have potentially at least one or two more near-term runs out of this particular intermediate run that we're on right now before we finally do get our quote-unquote pullback, where we break that 23% line and drop down and start flirting with that Fibonacci retracement zone starting at the 38% level. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What are you seeing that suggests either you're a lot more bullish than I am, or that you're more bearish, that we are starting, we might not even get a week or two, and one or two more near-term runs, that we're on the precipice of something worse. So if there's something that's kind of driving that opinion for you, then share with us and share with our viewing community here down in the comment section below. All right, now let's take a look at what's going on here in some of these other markets. And specifically, let's take a look at what's going on in the dollar. So the dollar had been pretty bullish, but more of a kind of a really oversold technical bounce to the point where we got above the 17-day exponential moving average. But one day later, we're right back down below the 8-day. The histogram's rolling over. The MACD is still negative. It's above its moving average, but still negative. The stochastic hasn't gotten up to the upper reversal zone. So the dollar is kind of making a run. Has made a little bit of an oversold bounce. Light green shading, but potentially rolling back down here with the near-term divergence, bearish near-term divergence in the near-term line, getting back below 50 here. Just a couple brief little near-term rallies. So again, remember looking at the long-term picture for the market forecast on the dollar, dark pink shading and a red line, that's bearish. And the more bearish the dollar is, the more bullish risk appetite is. So very, very good sign for risk appetite that today we saw a nice little rollover in the greenback. If you take a look at the dollar versus some other currencies. You can see the big bounce in the euro there, and one reason why the dollar was so bearish. When you look at it compared to something like the Aussie dollar, you can see we're back to dark green shading and a green line on the Aussie dollar. And you look at it compared to the Canadian dollar, see how it's rolling over and falling back down, dark pink shading and a red line. So all good signs. Again, not necessarily a good sign for the dollar, but good signs for risk appetite as a whole. If you look at the 10-year yield, it's been pretty sideways, up and down, really not going much of anywhere. So it's got, it has to really kind of break out here to get going, and it's not really breaking out. It's got this gravitational pull around this point of control. It can't quite get above it, but it's also not breaking down below it either. So you can see this big move higher, and I have to zoom out a little bit on the long-term bond ETF, but we've had this big move higher since the fall of 2018 that culminated here with this big, COVID bounce, extreme high point that we've had. Well, we broke below the 23% level, held the 38, but is unable to get back above. So you can see the opportunity it has to break not only to the 38, but potentially all the way through to the 50% retracement, where the next kind of more significant layer of support is. Again, that's long-term bond prices. That means yields have the potential to rally through there. So something to keep an eye on. If you take a look at crude oil, it's been so oversold, but you can see, very little volume ahead. So it's been a nice, good run to the upside, and that run's continuing for commodities. So it's got a lot of overhead resistance, so it's not like we're going to break out anytime soon. But to be back to 40 after being way, way down is a very good sign for crude. And if you take a look at the commodity basket here as a whole, a lot of opportunity for this to go up higher before it meets up with any significant resistance. So it's a lagging indicator. Stocks are obviously already up towards those highs. You wouldn't expect this to be, but still a good sign to see them on a bullish trend and moving their way up to the upside. Here's what the 3-month chart looks like. The Qs obviously regaining their leadership over the 3-month period. The small caps are doing pretty well too, which is a good sign. International stocks have been underperforming, still underperforming a little bit, but that's, again, with a weak dollar, you wouldn't expect that to last very long. You'd expect these international stocks to really start gaining some relative strength compared to their U.S. peers. Maybe not the Qs, but at least like the S&P. You can see also high yield has been doing a very good job. It had been actually kind of holding up with some of these other equities, and they've pulled away here in the past week or two. Long-term bonds have been flat and haven't really started to fall yet. So in gold especially, hasn't, it's been lagging, but it's been outpacing other commodities. So we're not quite there, or at least the basket, which includes gold to a degree. But it's been holding, but that weak dollar has really helped gold maintain a nice little bullish move. If you take a look at the futures contract for gold, you can see the potential it has for a breakout, and you would expect it to if the dollar continues that weakness, even if risk appetite increases, right? You would expect this trend to continue to move to the upside. Here's the Hakinyashi candle on the weekly chart. I mean, again, it's very strong after a couple transition candles that didn't turn into a trend change. Now we're back to a bullish Hakinyashi candle and the opportunity for a little bit longer. Again, you would expect that, not necessarily because we are risk off right now, but you would expect it because of the potential for the dollar to be as weak as it is. Again, if I were to go back to 2017, one of the stronger periods of stock moves up to the beginning of 18, you can see crude oil went from, $11.50 eventually up to about $13.50 during that run, even with stocks doing very well during that run. All right, now let's take a look at how the sectors are performing. You can see the 3-month returns and how strong energy prices have been, even with a little bit of a decline here on the last little bit. Let's just look at just today, though. So let's go to June and look at today's movement. You can see our large cap tech names are dominating, right? And even consumer discretionary are doing well. On the other end, financials, energy, which have been some oversold bounce. Even industrials, when the Russell 2000 has made a little bit of a run, those sectors in particular have been kind of leading the charge, but not so much today. In fact, if I go back just the last 5 trading sessions, you can see the S&P is up, and it's pretty much all technology. There's a little bit of discretionary in communication services too. Healthcare has had a little bit of a bounce, but industrials, financials, energy all down. Utilities and real estate down too, but those are interest rate sensitive areas. They're still dropping. They're also safe haven areas, and they have been so bullish on a long-term basis. Like for example, like on a 1-year chart, they had been so bullish over here, but now they're starting to really lag behind down towards where industrials and financials and energy are on a 1-year basis. And look at that strong return, 32% return on XLK. Again, it's almost as if none of this even happened, because that's still a pretty decent 1-year return regardless. And even some of these returns in some of these other areas, again, goes to show how strong the risk on move has been. Again, going out a couple of years, and you can see the strength of utilities and real estate really strong here, especially going even into the coronavirus. They were very, very strong along with technology. Of course, now they're not as strong, and some of these other areas are picking up, but not industrials, financials, energy. Now, the more the dollar retraces, if I were to go back towards that 2017 time frame, so even just the whole year of 2017, when the dollar had a big, relatively big decline during that year. So here's a 1-year chart with the falling dollar, and you can see financials and industrials actually did pretty well on a yearly basis. All your safe havens are down here. The dollar, the S&P was up 20%, and of course the rest of your cyclicals are up here too. Energy struggling despite the strong dollar, a weaker dollar. But those areas finally do pick up in a weaker dollar environment, and you can see how weak the safe haven areas would do in that situation too. This is what their 3-month charts look like. Again, we're almost all above the moving average. Energy is still kind of struggling with this moving average. It's the only one with the dark pink shading. Utilities is below its moving average, along with healthcare, all yellow. But for the most part, dark green shading and green lines, and a little bit of a pullback in some of these. And otherwise, light pink shading and green lines in some of these other areas. Again, just signifying the pullback that we've had, the relative weakness that we have, but not enough to change things around. You can kind of see too, from a global perspective, here's all the biggest economies on a global basis, and dark green shading and green lines across the board. So very strong move and risk appetite all over the place globally, not just here in the U.S. So again, a kind of a broad buying, which is what you like to see. All right, so for our trade idea of the day, I wanted to take a look at a stock that's got a relatively bullish bias to it, and that's a Target. Target's been back to dark green shading the green line. Its near-term line's bouncing, and the intermediate line's still below the market sentiment, so it hasn't really crossed back up above it. So it's not strongly bullish, but it's not bearish either. And you can see on the Bollinger Band that we are above the point of control. We're not through the value. There's some resistance above us. There's some pretty decent support below us. So that should probably guide you into what I'm thinking in terms of what kind of trade to make here. You can see its oscillators are bullish, but not breakout bullish. Right? We haven't broken above 100. We haven't broken above 60 here. You look at its DMI, again, bullish, but not breakout bullish. Right? We're above 25, below 20, but not above the 30 yet, which is what causes the breakout there. You look at its trend strength indicators, and you can see, that's not strong at all. We were strong, but now we're not very strong. And the ADX, as you saw on the previous chart, was pretty weak per se. Here's the long-term chart. Again, bullish bias, but not really getting some strong bullish signals, and way below where the momentum was the strongest right now. So it's kind of hard to, after you get such a strong peak, 20+%, it's hard to really get going again. A lot of times you get divergences when you get such strong peaks. So that sets us up for the possibility of doing an iron condor, and we did this. The trade didn't go through yet during my market outlook live session. But what we'll look at here is doing the 116, 114 bull put spread, and then on the other side we'll do the 129, 131 bear call spread. You can see it's a relatively wide spread, that's why we didn't get filled in. So you have to keep that in mind here, and with where you'll end up getting filled at. You can see we position size around a full position size because we don't have to worry about earnings, and then we'll end up seeing what we get. Remember, if we can get at least 60 cents, that would be ideal. If we can get around 65 cents or so. So we'll see what end up getting. If you end up getting less than 83, then we have to dial this back probably towards 8 or 7 contracts to stay within the regular loss area and still give us plenty of return to justify the risk. So I'm actually going to confirm and send and put that into our market outlook category and have that ready to go for tomorrow morning. Let's see if we can get filled in on that. But you can see the break-evens are where these blue lines are. So if I were to do target here, there's one blue line. So that's our blue line to the downside where our bull put spread is. And then here's our blue line to the upside where the bear call spread is. So plenty of room to work with to the upside. A lot of support below us to the downside that can help keep us above the bull put spread. Willing to lose, in this case, $600 because that's what I'm trying to make. You can see it have to really go beyond to get to 600 on either direction. Have to really make a significant move. So we have a lot of room to work with before we'd have to worry about closing out this trade with a loss that would be acceptable for the return we're trying to get on this. Alright, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link right there to go to our forums at marketscholars.com, specifically our Market Outlook forum, and post any questions or comments you have there. Reply to anybody else's threads too, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow us on Twitter for more content in between videos. Join our community at marketscholars.com. We got a great growing community, so appreciate all of you who already have joined, and welcome to any of you new viewers to come join us as well, and also join our Market Outlook Facebook group that we've created. Have a great rest of your Monday night, everybody, and we'll see you all next time.